Welcome to TalkTickers. We dive deep into earnings calls, pulling out the insights that, well, really matter.
And today we're getting into APi Group's first quarter for 2025.
Yeah, looking at their earnings call, the big picture, it looks like a pretty solid start to their year.
Definitely. Good revenue growth, and looks like real progress on the profitability side too.
Okay, let's jump into the specifics then. What are the headline numbers?
All right, so APi reported a 7.4% increase in revenue overall, which brought them to $1.72 billion for the quarter.
And how much of that was organic growth? Sort of underlying business strength?
Good question. Organically, they grew about 2%. So positive momentum there.
Right. It sounds like maybe not all parts of the business grew equally, though.
That's right. The safety services segment, that was a real standout.
How much does that grow?
Organically, 5.6%. And a lot of that was driven by inspection, service, and monitoring. IS&M, as they call it.
Okay, the recurring revenue stuff.
Exactly. And get this, their North American inspection revenue, double-digit growth. Wow.
For the 19th consecutive quarter.
19. That's quite a streak. It suggests real strength there.
It really does. It points to, a solid market position.
So safety services strong. What about the other side, specialty services?
Yeah, specialty services actually saw revenue dip a bit, down 6.8%.
Okay, that's a contrast.
But, and this is important, their backlog in specialty services, it actually grew.
Oh, interesting.
Yeah, organically up 7%. So while current revenue was down, the pipeline of future work looks, well, strong.
So maybe some timing issues or near-term headwinds, but the demand's still there.
That seems like a fair read. Management seemed to think so.
Got it. Let's talk margins then. Profitability, said that was up.
It was. Adjusted gross margin improved to 31.7%.
Which is how much better than last year?
That's a full percentage point higher, 100 basis points.
A full point is a pretty big move at that scale.
It really is, and that flowed through, to their earnings.
How did adjusted EBITDA look?
Adjusted EBITDA was up 10.3% reported. Okay.
Or 11.5% if you look at it on a fixed currency basis.
And the margin itself?
Reached 11.2%, so making good progress towards their targets.
And the bottom line, adjusted EPS.
Adjusted diluted earnings per share, that increased by a solid 8.8%, came in at $0.37.
Okay. Growth across the board, pretty much. What about cash flow? Always critical.
Very critical. And they did well here, too. Generated $86 million in adjusted free cash flow.
How does that compare?
It's a really significant jump from the same quarter last year.
Nice.
Represents a strong 45% conversion rate, turning those profits into actual cash.
And it seems like they're putting some of that cash to work for shareholders?
Absolutely. They bought back $75 million of their stock during the quarter.
Okay.
And maybe more significantly, the board authorized a new share repurchase program.
How big?
$1 billion.
Wow. Okay. That's a pretty strong signal.
Yeah, signals confidence, right, in future cash flow. And maybe they think the stock's a good buy.
Let's circle back to safety services for a sec. That 19 straight quarters, what's driving that consistency?
It's fascinating, isn't it? A big part is probably the nature of the work. Inspections, service, monitoring, a lot of it is recurring.
Right, often mandated by regulations.
Exactly. So it's less cyclical, maybe. Plus, it suggests they've got a strong market position, good customer relationships. They must be doing something right.
Definitely. Then on the flip side, specialty services, revenue dip, but that growing backlog, what's the dynamic there?
They said the revenue dip was kind of expected, timing of projects, maybe some weather impacts they mentioned.
Right.
But that 7% organic backlog growth, that's the key indicator for future potential.
So the demand is solid.
Seems like it. The issue in Q1 was probably more about converting that backlog, maybe some project delays hitting fixed cost absorption.
Which would explain the lower margin in that segment.
Precisely. They expect it to bounce back to positive organic growth in Q2, though.
Okay. Now, margin expansion overall is clearly a big focus. They've talked about that 13% target for 2025. What are the main levers they're pulling?
It's really a multi-pronged thing. First, improving the revenue mix, more of that high margin inspection and service work.
Makes sense.
Then being more disciplined about, which customers and projects they take on, focusing on profitability.
Better selection.
Right. Plus getting value and synergies from acquisitions like Chubb.
Okay.
Also pricing improvements, procurement savings, finding efficiencies there. And strategic M&A is still part of the picture too.
So attacking it from multiple angles.
Yeah, pretty comprehensive approach.
What about the broader economy? Inflation, potential tariffs, everyone's talking about that. How do they feel they're positioned?
They seemed pretty confident, actually. For the recurring service stuff, which is over half their revenue,
Yeah.
they said minimal impact expected. It's mostly labor costs, and material costs tend to get passed through.
Okay, so that part's fairly insulated. What about the project side?
There, they have contractual clauses, usually, to pass on material cost increases, especially thinking about things like North American pipe prices potentially hit by tariffs.
I think they've built in protection.
Seems so. And longer term, they actually see things like infrastructure spending and, onshoring trends as potential positives for their end markets.
Interesting. So maybe some near-term noise, but potential long-term tailwinds.
That's the view. They even mentioned pre-buying some materials just in case to get ahead of tariff impacts.
Proactive, okay. And they've got those longer-term targets they keep mentioning.
Yeah, the 4, 3, and 60/80 goals, they call them.
Right. Remind us.
So 13% or more adjusted EBITDA margin by 2025.
Okay.
60% of revenue coming from that inspection, service, and monitoring business.
The recurring part.
Yep. And 80% adjusted free cash flow conversion over the long run.
Gives a clear picture of where they want to go. How are they planning to use their capital to get there, besides the buybacks?
Priority number 1, they said, is value-enhancing M&A, bolt-on acquisitions.
Any specific target areas?
They're targeting about $250 million in bolt-ons this year. And interestingly, that includes their first move into elevator services.
Oh, a new adjacent market for them.
Exactly. After that, it's the opportunistic share repurchases like we saw. And they want to keep leverage down below 2.5 times net debt to EBITDA.
Sounds prudent. Now, their guidance for the rest of the year,
Yeah.
they raised it, right? Yeah. What's behind that optimism?
They did. Full-year revenue guidance is now $7.4 to $7.6 billion.
Okay.
Which implies 2 to 5% organic growth for the year.
And EBITDA.
Projected at $985 million to $1.035 billion. The midpoint there gives a 13.4% margin, so already hitting that target range.
And Q2 looks strong too.
Yeah, the Q2 guidance suggests accelerating growth, about 3 to 6% organic revenue growth expected.
What's driving the raise? Just performance or?
Performance is part of it, but they also mentioned the weaker U.S. dollar. That actually helps boost their reported international revenues.
Ah, the FX tailwind. Got it.
Yeah.
I also saw they're making a big investment in systems and technology.
Yeah, a 3-year plan. It's about giving their field leaders, better data, better tools.
To do what exactly?
Drive efficiency, improve customer service. They see it as a key enabler, really, for hitting those long-term financial goals, making the whole operation run smoother.
Makes sense. You need the right tools. What about the backlog overall? You mentioned specialty services grew, but combined?
Combined backlog is still strong, around $3.5 billion, and it's showing year-over-year growth.
And crucially, are they seeing projects get delayed or pulled because of tariff worries or economic uncertainty?
Management specifically said no. They haven't seen significant delays or pullbacks related to tariffs. They're actually seeing continued momentum in building that backlog.
That's a positive sign. How's the international piece doing, especially with Chubb now integrated?
Performing pretty much in line with what they expected, delivering mid-single-digit organic growth.
So Chubb integration seems to be going okay.
Looks like it, contributing as planned.
Okay. There was also a quick mention of a rural broadband program. Is that significant?
They described the revenue from that as kind of choppy,
Okay.
but said it's already baked into their forecasts. So sounds like maybe an opportunistic thing, not a core consistent driver right now.
Gotcha. And they seem bullish on bigger trends like reindustrialization in the U.S.
They do see opportunities there, yeah.
Yeah.
Especially for landing some larger projects.
A different kind of work for them.
A bit, yeah. But they were quick to emphasize that their core strategy is still growing that recurring IS&M base. The big projects are more complementary.
Sticking to their knitting, mostly. Looking even further out, beyond 2025, where do they see more margin gains coming from?
Pretty much continuing the current playbook, it sounds like. Improving the mix, being selective on projects,
Right.
Getting ongoing synergies, pricing power, procurement efficiencies, just overall better branch performance.
So continuous improvement.
Yeah, and they actually hinted there could be significant potential for more margin upside beyond the 13% target. Suggests they see a long runway.
Interesting. What about wage inflation? That's hitting a lot of service businesses. How are they handling it?
They're definitely managing it, especially for service techs. They mentioned having good visibility, particularly with union agreements in North America fire service.
And they know what's coming.
Largely, yeah. And they're proactively building those expected wage increases into their proposals and pricing, trying to offset the impact.
Okay, makes sense. Finally, if things did slow down, a potential recession,
Yeah.
how resilient do they think their business is?
They feel pretty well positioned. They highlighted a few things. One, a highly variable cost structure, about 70% variable.
Which gives flexibility.
Right. Two, they pointed to their performance back in 2020 during the pandemic. They actually expanded margins
A
then.
good track record.
Three, strong cash generation, even when things slow down. And four, just the stability of that recurring inspection and service business. It holds up relatively well.
Plus, the project backlog provides a buffer, too.
Exactly. Gives them some visibility, even if new project awards slow down for a bit.
Okay, that covers the call pretty well. Now, as always, this is not financial advice, but based on what we've heard.
Let's hear the outrageous but plausible trade idea for today.
All right. Given API's focus on that stable, recurring safety revenue, and now they're adding elevator services, consider this. Go long API Group
Okay.
and simultaneously short, say, a pure-play manufacturer of new commercial HVAC systems.
Interesting pairing. What's the thinking?
The idea is API's mandated services, plus the new elevator maintenance stream, should be pretty defensive if the economy cools. People still need fire inspections, elevators maintained.
Right, less discretionary.
Exactly. Whereas new HVAC systems, highly tied to new construction, big capital projects, those could get hit hard in a downturn or with high interest rates.
So you're betting on API's resilience and new growth vector while hedging against broader economic weakness that would likely hit the HVAC maker harder.
Precisely. Isolating the potential alpha from API's core stability and their strategic move into elevators. It's a play on relative strength in a potentially uncertain environment.
I see the logic. Definitely fits the outrageous but plausible category.
So wrapping up our deep dive on API Group's Q1 call.
Yeah, I think the key takeaways are pretty clear. Continued strength in safety services, that recurring revenue engine.
Definite progress on margin expansion. Looks like they're on track for their 2025 goals.
And generally a confident outlook, right? Supported by that solid backlog and their strategic moves like the elevator service expansion.
Plus, the big share buyback sends a strong message too. Focus on growth and shareholder value.
Absolutely. As always, we encourage you to do your own research, dig into the numbers and strategy yourself.
What stood out most to you from this? Any lingering questions about their path forward or that elevator expansion?
Lots to think about. Thanks for tuning in to TalkTickers.
Join us next time as we unpack another crucial earnings call.